The Federal Reserve, the Fed, is raising interest rates. This is an important event that will have significant impact on the housing market in the United States. Today we will take a look at what the Fed hikes rates mean for homebuyers, sellers, and homeowners. First, I'd like to thank you for joining our Biesinger Fire journey. I am Jordan Biesinger, and in this channel I share my family's financial freedom journey with tips and tricks on finance, investing, and more. If you found today's video helpful, please click that lonely little like button, comment, and share with a friend. So what is the Federal Reserve? The Federal Reserve is the central banking system of the United States. It was created by Congress in 1913 in response to a series of financial panics that had plagued the country. The Fed's primary responsibilities include promoting economic growth and stability, supervise and regulate banks and other financial institutions, provide financial services to the government and the public. The Fed is often referred to as the lender of last resort. This is because they can provide loans to banks when they are experiencing difficulty obtaining funding from other sources. They are actually not a federal entity at all, but a quasi-public entity. Its creation was to serve as a buffer against financial panics and recessions. There are a lot of divisive opinions about this establishment. One perspective is that the Fed is too powerful. The rate of currency creation can raise inflation, making it more difficult for consumers to save money. Many people that live paycheck to paycheck resent this inflationary pressure. When the Federal Reserve increases the rate of inflation, savers lose the value of their currency. Borrowers make money by taking advantage of low debt costs to invest in assets. The Fed manipulating interest rates can have widespread effects. For example, one of the reasons for the subprime mortgage crisis in 2008 was caused by the Fed keeping rates artificially too low for too long. This led to a housing bubble which eventually burst, causing a financial crisis. An opposing perspective is that the Fed isn't powerful enough. The Fed's primary tool is interest rates, and there are limits to how low they can go before hitting zero. This means that the Fed does not have a lot of room to maneuver when it comes to stimulating the economy. The decision of the Fed to raise interest rates will have different effects on different groups of people. Now let's discuss, what does the Federal Reserve do? The Federal Reserve performs several important functions, but it has two main goals. 1, promoting maximum employment. 2, stabilize prices or inflation. The Fed does this by setting interest rates. When the economy is strong and inflation is low, the Feds will raise rates to prevent the economy from overheating. Conversely, when the economy is weak and inflation is high, the Fed will lower rates to stimulate economic growth. This prompts investors and business owners to borrow currency to reinvest into the production of goods and services. The Federal Reserve also regulates banks and other financial institutions to promote stability in the financial system. By controlling the banking system, the Fed can influence the availability of credit and the cost of borrowing. This lending helps to prevent bank failures and maintain confidence in the banking system. As a real estate participant, this affects you. When banks have more confidence, they are more likely to lend money, and when borrowing costs are low, it affects your mortgage rates. Unless you are paying for the property in 100% cash, the interest rates on your mortgage has a direct correlation with the actions of the Federal Reserve. When the Fed raises rates, it becomes more expensive for banks to borrow money. As a result, banks will raise the prime lending rate. This is a rate at which banks lend money to their best customers. The prime lending rate is used as a benchmark for other rates, such as the rate of a home equity line of credit or a 30-year fixed mortgage. The Fed decision to raise interest rates will have different effects on different groups of people, as mentioned before. Homeowners with adjustable rate mortgages will see their monthly payments go up. The same is true for people with home equity lines of credit and student loans. On the other hand, savers will earn more interest on their deposits. So why is the Fed raising interest rates? The main reason why the Fed is raising interest rates is to keep inflation in check. When the economy is strong and growing quickly, prices for goods and services tend to go up. The Fed's goal is to raise rates just enough that the inflation stays at a healthy level, but not so much that it slows down economic growth. As mentioned earlier, another reason why the Fed is raising interest rates is to prevent the economy from overheating. When the economy is doing well, it can sometimes lead to too much growth. This can cause problems, like what happened in 2008 when there was a housing bubble. By raising rates, the Fed can slow down economic growth and prevent these bubbles from forming. Finally, the Fed is raising interest rates to normalize monetary policy. For the last few months, the Fed has kept rates at historically low levels to stimulate economic growth. Now that the economy has started to recover, it's time for rates to go back to a more normal level. So how does the federal interest rate increase affect home buyers? As a home buyer, you may be wondering how the Fed's decision to raise interest rates will affect you. The most immediate effect will be higher mortgage rates. If you are in the process of shopping for a home, you may want to consider locking in a rate now before they go up in the future. If you have already been pre-approved for a mortgage, you may still be able to lock in at a lower rate if you act quickly. The good news is that your home can still be considered an asset if you rent out some of the space in your new home. A larger down payment can also help alleviate the debt burden and increase your monthly cash flow. In the longer term, the Fed's decision to raise interest rates could have an impact on home prices. When rates go up, it becomes more expensive to borrow money, and this can lead to slower economic growth. This could cause prices to rise more slowly or even fall in some markets. Of course, the Fed's decision is just one factor that can affect home prices, and so it's impossible to say exactly how this will play out. If you're thinking of buying a home, it's important to do your own research and perhaps talk to a financial advisor to get the best advice for where you live and your situation. To summarize, the effects on home buyers can be complicated, but there are two main ways that higher interest rates will influence buying decisions. So homeowners who are on the fence about whether or not to buy may now decide to wait because their monthly mortgage payment will be higher than it would have been otherwise. This could lead to lower demand for homes and put downward pressure on prices. On the other hand, higher interest rates could lead to more people wanting to buy now because they're worried that prices will go up even further in the future. This could lead to higher demand for homes and put upward pressure on prices. It's impossible to say definitely how the Fed's decisions will affect home buyers, but it's important to be aware of the potential implications before making any decisions. So how does the federal interest rate increase affect home sellers? Home sellers are not likely to see an immediate or significant change as a result of the Fed's interest rate hike. However, over time, higher interest rates could make it more difficult for buyers to afford a home, and this could eventually lead to fewer sales. Another way that higher interest rates could affect home sellers is by influencing the decision of whether or not to buy a replacement home. If you're thinking of selling your home and buying another one, you may want to consider doing so sooner rather than later. It will likely be more expensive to finance a new purchase when the interest rates are higher. Finally, it is important to remember that the Fed's decision is just one factor that can affect the housing market. Other factors such as job growth and the overall strength of the economy will also play a role in determining whether now is a good time to sell your home. If you're thinking of selling your home, it is important to talk to a real estate agent to get the most up-to-date information on the market in your area. It can be difficult to know what to expect in the current market, but a real estate agent will be able to give you the most accurate advice. In summary, while higher interest rates may eventually lead to fewer sales, it is not likely to have a significant impact on the home sellers in the short term. However, if you are thinking of selling your home and buying another one, you may want to do so sooner rather than later. Now, I want to discuss how the federal interest rate increase affects homeowners. As mentioned earlier, homeowners with adjustable rate mortgages, ARMs, adjustable rate mortgages will see their monthly payments go up. For example, let's say your rate is currently at a low rate of 3% and the Fed raises by a quarter point, 0.25%. You would see your interest rate jump to a 3.25%, and that could continue to rise as the Fed raises rates in the future. If you have a fixed monthly mortgage, your monthly payments will stay the same for the life of your loan. Homeowners in this situation have less to worry about with the Fed interest rate hikes. It's important to be aware of how much the interest rate will rise and if you can afford the monthly payments. You may need to start looking at other ways to cut costs in other areas of your budget. Raising your income is always a possibility. You may want to consider refinancing your mortgage to lock in a lower interest rate if rates continue to rise. So there you have it. The Federal Reserve's decision to raise interest rates will have different implications for home buyers, sellers, and homeowners. It's important to be aware of how this could affect your own situation before making any big decisions. Understanding what the Federal Reserve does and how its decisions affect the economy is important as well when it comes to your financial future. So remember to continue your learning, do your research. It's also important to learn about economics and how it affects your personal finances. Whether you're a real estate investor, home broker, or mortgage borrower, knowledge is power. Make sure to check out other valuable videos in this channel. And if you found today's video helpful, please subscribe and click that notification bell so you don't miss out on more content to come.